Hi guys. Today we will analyze Toyota Motor stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been an average performer in the overall market. Also recent evolutions are not positive. The short-term trend is negative, while the long-term trend is still neutral. We need to see a little more continued positive action to open a long position. Strong support level is around $156. Next strong support levels are around $145 and $130. Strong resistance levels are around $174 and $186. Next strong resistance level is around $210. In the last month the stock has been trading between $155 and $174 range, which is wide. It is currently trading in the middle of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 0.3 million. This is not a very liquid stock. The stock has been in a downward trend since January 2022. Be careful. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. Toyota has been reporting very volatile and inconsistent free cash flow since 2016. So, discounted cash flow valuation may be inaccurate for Toyota, because it's hard to predict its future free cash flow. So take it with a grain of salt. First model. Discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 0% per year, for last 5 years. We see that the average profit margin of the stock has been around 8% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around -18% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Toyota Motor Company: bad, average, and good. First scenario. Toyota Motor will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 1%. Future profit margin would be low, 7%. Future free cash flow to net income rate would be low, 4%. In this case, the fair value of the stock today would be $53. Second scenario. Toyota Motor will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 3%. Future profit margin would be average, 8%. Future free cash flow to net income rate would be average, 5%. In this case, the fair value of the stock today would be $83. Third scenario. Toyota Motor will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 5%. Future profit margin would be high, 9%. Future free cash flow to net income rate would be high, 6%. In this case, the fair value of the stock today would be $123. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 15.79. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Toyota Motor, analysts forecast growth rate around 5% per year in next 5 years, and future P/E around 10. Again, I will use 3 different scenarios for Toyota Motor Company: bad, average, and good. First scenario. Toyota Motor will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 1%. Future PE would be low, 9. In this case, the fair value of the stock today would be $66. Second scenario. Toyota Motor will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 3%. Future PE would be average, 10.5. In this case, the fair value of the stock today would be $92. Third scenario. Toyota Motor will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 5%. Future PE would be high, 12. In this case, the fair value of the stock today would be $125. As you can see, today the stock is overvalued, $164, even if we expect the company's high performance in future. The fundamentals are decent, but there are some minor concerns on its financial health. Toyota has had a very volatile and inconsistent free cash flow since 2016. Sometimes its dividend is not well covered by its earnings. Also, the company is expected to show a small growth in revenue in the next 5 years, 3 to 5% yearly. Based on that, the stock looks overpriced at the moment. Also, the stock has been in a downward trend since January 2022, and it can go lower before it recovers. I may consider buying the stock when the stock drops below $125. Company's strengths. Toyota Motor Corporation is a Japanese multinational automotive manufacturer. It also provides financial services to dealers and customers, while also operating several other businesses. Toyota has made progress in expanding its electrified vehicle lineup, including hybrids, which now represents 28% of Toyota and Lexus brand retail sales. Toyota announced doubling to 30 all-electric battery models by 2030, committing $70 billion in investment. Toyota's manufacturing process is the gold standard of the auto industry. Its Toyota New Global Architecture platform lowers initial assembly plan investments by about 40%. The shared platform also maximizes R&D impact, as the result can be implemented across a wider range of models. Toyota's diverse model offering, continuous feature innovation, and wide distribution reach will help it to sustain at least low single-digit sales growths. Sales growth in Europe should remain decent, on increasing popularity of Lexus and hybrid models. Its popular vehicles usually allow Toyota to use fewer incentives than the Detroit 3, boosting the firm's profits and improving the resale value of vehicles. Significantly lower pension and retiree healthcare costs give Toyota a cost advantage over the Detroit 3. Toyota's return on assets of 4% and profit margin of 9% are amongst the best returns of the industry. Risks. Toyota continues to face supply chain shortages and increased materials costs, resulting in a lower outlook for full-year automobile production targets. Intensifying competition. And Toyota is not moving as aggressively on all-electric vehicles as its competitors. The auto industry is very cyclical, and it suffers from global overcapacity that creates pricing pressure and makes it difficult to earn high economic profits for all participants. Environmental laws are becoming stricter, which will make cars more expensive to produce, and more expensive for consumers to buy. Japan is an earthquake-prone nation, so Toyota can suffer supply chain disruption from disasters. Toyota has had a very volatile and inconsistent free cash flow since 2016. Sometimes its dividend is not well covered by its earnings. Toyota's return on equity of 11% is worse than the rest of the industry. The industry average return on equity is 25%, 80% of the industry peers have a better return on equity. The company is not financially healthy enough and could expect problems in meeting its short-term obligations. Based on estimates for the next 5 years, Toyota will show a very small growth in revenue. The revenue will grow by 3 to 5% on average per year. The earnings per share is expected to grow by 6% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.